Hello and welcome. This is the Insurance Pro Blog Podcast. This is episode 419. I am Brandon Roberts.
And I am Brantley Whitley.
And you are listening to the internet's favorite podcast about life insurance.
That's right.
And all of the wonderful things that life insurance has to offer you.
That's right. Well, last week we talked about the terrible things you could do with life insurance. And
we did. Today we talk about the wonderful things.
Yeah.
We like having that high and low.
Yep. Well, speaking of highs and lows, seen a few of those in the last few days, huh?
Yeah. The last couple of weeks have been a grand lesson in why we diversify. And more specifically, why we diversify in assets that are not correlated to the market.
Yeah. I think there's probably a whole new generation of people that just learned what volatility meant.
Yes, yep.
I've heard that word. I don't really know what that means.
Now, my generation is like, oh, you mean our third or fourth once in a lifetime recession?
This is happening again?
Huh. Imagine that.
Yeah. Exactly. People have been around for a while, kind of yawn and go, yeah, seen this before. So,
older millennials, young Gen Xers.
Yeah.
Big market crash comes along. It's kind of like a Ben Carson lecture.
Yeah. Some people will get that. Yeah. Well, it's one of those things where people of my generation and largely yours go, I'm probably never going to retire anyway. So,
but for those who want to.
Sure.
You could think about diversification outside of the market.
Yeah.
Which is what we've been talking about for years.
The ultimate non-correlated asset.
Yes, that ugly word, non-correlated asset, or ugly phrase, whatever you want to say.
Yes.
That some people think is bad and we shouldn't use it, but we're going to because we're dumb and we do that.
I lost everything you said there.
Oh, I was just...
The internet's being the internet.
Yeah, I was just saying that...
Yes, I agree.
You have no idea what you just agreed to. This is good for me.
Exactly. Yes, I will sign everything over to you.
Yeah, right. So, look, bad markets are bad markets. And for years, financial advisors, investment advisors, whatever you want to call yourself in that subsection of the financial industry...
Financial websites, financial TV.
Right. There's always the advocacy of don't freak out. These things happen. And usually, and it's certainly happening now, we get the rollout of the 5 and 10 year mountain charts of the S&P 500 or the Dow or whatever to show us, look. Now we're only up 145% versus 175% for the past 5 years or 10 years or whatever it is.
Right.
Which seems soothing when you are deep in the weeds of the financial industry and you know what you know. But for the layperson, you can take your 5-year mountain chart and do something with it.
Well, I mean, if you were thinking about you're going to retire at the end of April,
mm-hmm.
and May 1st was going to be your first retirement liberation day. See what I did there? And then Liberation Day came, and your $1 million now looks like something less than $1 million.
Yep.
Substantially less.
Right.
I think this is just human behavior. This does not have anything to do with any one person. That $1 million was anchored.
Yeah.
In your brain. You thought, well, I got $1 million. So. And now it's like, well, I got $750,000.
Yep.
So that's a big hurdle to overcome.
It is.
And makes income creation a little more complicated.
It does. It definitely does. So we understand the argument to sit and calm down.
Yeah.
And nobody's here to argue against the data that is plentiful, that supports that claim.
Right.
But there's also an overwhelming amount of data that says people will not listen. And that's where we have to, as professionals, sit down, take stock of what we're doing, and say, all right, we may have a beautifully constructed system here.
Mhm.
And there might just be really good, irrefutable logic behind our claim that if you just chill out, everything will be fine.
Yep.
However, there is also a ton of data that says people don't listen and they don't interact that way with the products that we sell them and the way that they interact with them in these moments.
Right.
I am sure there are a lot of product manufacturers who looked at the ways some people managed to hurt themselves with their products and thought, well, if you weren't dumb, that wouldn't happen. But that's not a good defense in a court of law.
Very
So
true.
you have to eventually take stock of how the end user uses the item. And if they won't do what you intended for them to do with it, you got to change strategy. Pounding the table and saying, no, just read the damn manual and you'll be fine is not obviously changing human behavior.
Right. So what you're saying is, I'm really not supposed to stand on the top of the stepladder? Is that?
That's not what that top step's for. We don't even.
Is that
it's
why
not
I said
even
it's not a step? Do
Yep.
not.
Right. Mm-hmm. Nope. It's not there for that.
Every guy in the United States goes, hold my beer. Watch this.
So, and look, again, the data's overwhelming. If you just stay the course, you'll
Sure.
be fine.
Right.
But everybody, including us, looks off into the distant abyss of a newly forming market downturn
Mm-hmm.
and has a little nagging thought in the back of their mind that says, but what if this is the one?
Right. Well, for me, I'll say personally, that's never the thing. It's always how long.
Right.
It's just it's a matter of, and no one can answer that question.
Nope.
It's a rhetorical question.
Mm-hmm.
How long will it take?
Yeah.
And if you're on the door of needing to rely on this in the traditional sense, I'm not talking about income generating assets to fluctuate in market value, because that happens all the time. But I'm talking to the 4% rulers out there,
Mhm.
or 4%. Should we call them 4%ers? I don't know. The
Sure.
people who are just planning on taking withdrawals from their account.
Yep.
To fund their retirement. Things get a little bit dicey when these times comes along.
It does. It just gets scarier. And we have shown time and again that on the distribution side, moments like this, if your retirement date was now or even the beginning of this year,
Yeah.
your income prospects, your wealth preservation prospects are irreversibly shifted downward from here.
Right.
If you are taking income while the market is declining, that's not good news. And you are now forever going to have less buying power and less overall wealth accumulated from your portfolio because of the timing of this event.
Right. And again, just to clarify, because I want to be clear, we mean in the context of you're literally selling shares of whatever it is you own to
Correct.
to quote unquote produce income. That you're not actually producing income, you're just selling assets. But that's the context we're talking about.
Yep.
And now to get back to our original point, let's not belabor that too much, because I think everybody gets that. There are many out there who have preached for years that I'm trying to think of the best way to express this. That various types of market-related assets are inversely correlated or non-correlated.
Mm-hmm.
We don't buy that.
No. So, for example, stocks are inversely correlated to bonds.
Yeah, that's a classic, right?
Yep.
Until they're not.
Right.
And we've done past episodes where we showed you that.
They're pretty tightly correlated. When stocks fall, bonds fall.
In a lot of cases, right? It's not always permanently that way. We're not suggesting it always has to happen that way, but we can point to many instances where that has happened.
Yep.
So it doesn't work in practice.
Not if we start to introduce the way bonds are purchased by typical retail investors.
Yeah.
That's what causes the correlation. It's not that fundamentally bonds are correlated with stocks.
Right.
It's that the mechanisms through which people generally access bonds has become correlated with stocks.
Right. Correct. Which is generally bond funds in their 401k
Correct.
or something like
Correct.
that.
Correct.
Yep. So cash value life insurance
Mhm.
is truly non-correlated.
Correct. So cash value life insurance is not designed to fluctuate with market conditions. In fact, it really can't fluctuate with market conditions.
But what about IUL, Brandon?
Well, that's the
Because
closest.
I know someone's going to come along and ask that question.
That's the closest you can get to somewhat fluctuation with the market.
Yeah.
But there is a hard limit to how far it can go down, which is zero.
Right.
So if the market crashes, that results in a zero or very small interest payment on an indexed universal life insurance policy.
Yep.
That is not the same as a down 20% in the
Right.
market situation.
Exactly. You can have a variation of positive returns.
You can. Now, that does mean there is some volatility or fluctuation, if you will, to the interest rate you are anticipating on your indexed universal life insurance policy. We've seen that unfold now with everything that's happened very recently.
Mm-hmm.
But the result and the functionality changes. It differs considerably from the rest of the market as things recover, regress to the mean. Indexing has a way of just sort of standing where it was and then benefiting from a resurgence, which can be quite good in a lot of cases.
Yep.
And also benefiting when things are going well. So it's not the same. It doesn't have the same degree of volatility. And let's not forget that with indexed universal life insurance, most quality products have the capacity to access the money through a policy loan without having to worry, oh no, am I now selling out at a bad time and I'm going to miss the run back up?
Right. Exactly. Because all your money's still there.
Yep, it is. It's all still there and it all still participates in an index.
Yep. You basically just borrowed money from the life insurance company.
Yep.
And they collateralized part of your cash value to make sure they have some mechanism to take the money back if you don't pay it back.
Mm-hmm. But your cash in the index will continue to benefit from whatever the index return is, despite the fact that you actually have what seems to be the money that was in your policy now in your hand to go do whatever it is you want to do with it.
Right.
I want to kind of revisit and speak to a couple things on the psyche part, because there's some really good research that MIT has done on this and pointed out that, 58% of investors who panic sell, basically, they don't end up with positive results when they do that.
Right.
Like best case scenario, they're just trying to cut losses, but there's like a huge number of them who end up never returning to stocks in the market.
Right. Right.
And had they just waited like 20 days longer than the day that they just lost it and said, nope, I'm done, they would have ended up with much, much better results. So on average, it takes about 20 days for things to kind of come back around and it doesn't look so ugly anymore.
Yep.
Not new information, but again, even with this staring us in the face, most people won't listen. And
you and I have seen it personally.
Yep. And
we know people who bailed in 2020 and 2022.
We do. And the ugly part is when they bail, when it gets ugly. And then they start to get back in the water. And they start to make some commitments. And then it gets ugly again.
Yep.
So they do the same thing. And most of the time, as the MIT data shows us, and we have observed, they don't come back to where they were. They just keep buying and selling at new lower lows.
Right.
Now, I also see from this data something that makes very good intuitive sense. The people who are most apt to panic sell are really people who have identifiable things to lose.
Yep.
So to give you some makeup of these people, they tend to be men over the age of 45 who are married or have dependents. These are people who are worried about the financial viability of their families, and it makes perfect sense.
Yep.
So you can come with whatever mountain of data you wish to pull from the archives to say, no, it's going to be okay. That is still a very, very wide gap to bridge when you're talking about don't worry about that or don't worry about the market. It's going to be okay. Here's all the data that says it is. Well, they're staring at their kids or their wife and their house and all of the things that they've worked probably decades to build, thinking, I don't care what's in the future. I just want to protect this.
Right.
And again,
logic goes out the window.
Right. The data can say whatever the data wants. There's a very strong emotional reaction to all of this, that every attempt to hammer this down to a pulp with data has failed to win.
Yeah. Well, and that's, I'm going off script here a little bit, but I was thinking about this. This is because over the last few days, I've been watching the news, paying attention to what's going on like everyone else. And repeatedly you will hear commentators, pundits, whatever, talk about how in every market, they speak about this like it's some grand conspiracy that the rich get richer every time there's a market downturn because of this and that and the other. They have all their theories about it. The reality that you and I understand, because we've been doing this on a one-to-one level, not on a macro level for decades, is the reason that wealthy people get wealthier in periods like this is because they don't need all the money right now.
Yep.
So they're not as prone to panic. And in fact, if they have the means, they probably are prone to add to their accounts.
I'm gonna butcher the data reporting because I'm pulling from memory something I saw a little earlier today. So I can't even remember which. It might have been JP Morgan had this data that they released. So you're much less well-off consumer right now, or household rather. All of what's going on is eating up like 98% of their disposable income. Your kind of upper 10%. You
just mean with the inflation?
Yeah. And everything that's unfolding. Your upper 10% crowd, it's still only like 14% of their disposable income.
Right.
So even if it gets to 20 or 25, oh well, there's still 75% left over.
Right.
They have plenty of opportunity to do what they want to do, buy things at a discount in terms of assets. It's all on the table for them.
Yeah.
So to your point, this is why the rich get richer.
Yep. It's not some grand conspiracy.
No. So we advocate for life insurance as a diversification play because we've been doing this for a long time and we've been through a number of market fluctuations.
Yep.
Some have been somewhat moderate, just kind of years in the market. Others have been quite scary. The beginning of COVID, now. And 2022 was the stock and bond market collapse.
Yeah.
So weird times.
Which was a little bit slower.
Yeah.
It wasn't as sharp as
correct.
what we've seen.
But it was still like at the end of the year. They're both down.
Oh, yeah.
So we've seen all that. And we've also watched what has happened to the cash value accumulation of life insurance policies. We're talking whole life, we're talking index universal life insurance. And here's what we know, they just keep going up.
Yep. They just marched upward. I mean, have there been years where they didn't move at all? Yeah.
Yeah. The index universal life policies have encountered that.
Yep.
But we've also noted a few times in the past that the index universal life policies have actually done better than expectation, whereas the whole life policies have kind of met or slightly behind because of changes in dividend yields. They're still good. We're not upset. We're just, that's what's happened.
Yep.
So this reality with everything else going on, and I know there are people who don't like life insurance who are going to come along and say, yeah, but what if you had taken that money that went to life insurance and you had invested it in the market? Where would you be? You'd probably be ahead.
Yeah.
You probably would be ahead. The problem, though...
We don't even have to do some deep analysis on that.
Yep. The problem, though, and I'm telling you, this is hard to get away from. And you can tell yourself everything you want to about, no, I'm gonna think about that ahead of time. I'm gonna be ready for it. My head's in the game. I'll be fine. Maybe, but 9.9 out of 10 people who have said that and that I've known have failed to come through.
Yeah. Well, because the presupposition is I'm just going to prepare myself mentally for that. But then when it happens, everyone goes, I didn't see that coming. No one ever does see it coming. That's the point.
So here's the problem. So let's say instead of having $500,000 in cash value in your whole life policy, you would have had $800,000 of value in SPY because that's what you went for. Good for you. In your head, if you're like most people, you now have $800,000. And if a market correction comes along where you now have $700,000, the cerebral answer is, yeah, but you got more money. And you'd have more money than the whole life policy.
Yep.
But you've also lost $100,000.
Right.
And losing $100,000 is scary.
Right.
Because there's lots of things that you've already started to mentally prepare yourself that you weren't even thinking about as you saw the run up to, hey, I've got an $800,000 portfolio.
Right.
There's a certain amount of, I'm ahead of things and I can do things and I now live this life that is suddenly ripped away from you.
Mm-hmm.
And bad things psychologically unfold under those circumstances.
Mm-hmm.
When you have some whole life insurance or some index universal life insurance acting as a buffer, yes, you still own stocks. We have never, ever advocated you don't.
No, it's not an either or.
Right.
Sort of podcast. That's not what we do.
You benefit from stocks when they boom. That's great.
Yep.
But you own life insurance to protect from these moments so you're not freaked out. And for accumulation, it's a little less freak out. But for distribution, holy crap, is it scary.
Yeah.
So life insurance, what it lacks.
45 and still advancing in your career is a whole lot different than 68 and retired.
Correct. So, life insurance, it's not a robust, let's shoot for the moon accumulation strategy.
Yep.
But what it lacks in that capacity, it more than makes up for. And it's just complete indifference to bad economic news.
Yep.
Because I assure you, everybody who owns whole life insurance right now has not been checking their account balance to see what's going on with the market declines brought on by tariff policy. Because they know.
I haven't gotten any phone calls about it, have you?
No, I have not. It's never going to matter.
Right. The only messages I've gotten over the last couple of, because things have not been, obviously in the last week or so, we've seen extremes.
Mm-hmm.
But in the last couple of months, things have not been great. And the only messages I've gotten are really glad that I've got some of my money over here in this life insurance where I don't have to worry about that.
Yep.
And these are people who have other money, obviously, but in the market.
Yeah.
But there's a portion of their money where they know exactly, within reason, they know what's going to happen. So,
yeah. So the really cool thing about life insurance, though, is not only does it have that sort of protection from the freak out. It also happens to be a wonderful accumulator as a low risk asset.
Yes.
So it's not like sticking the money under the mattress.
No.
Or at least I can't lose it, but it's not going to rise in value.
Right.
Life insurance has a fantastic way of accumulating at a low risk profile with a host of additional benefits that you can seize.
Or other people can when you're gone.
Yeah. there's always that. There's always that.
How do I take $200,000 and turn it into $1 million?
Right.
Well,
right.
I know a way you can do it. You just got to be dead.
Yeah. Yeah. There's that. But realistically, I mean, who knows what's going to happen ultimately as far as market movements before things turn back around and we see improvement. There's a lot of volatility here. There's I mean, the fact that the market constantly has these crazy swing ups and then like soul crushing swings back down is kind of evident that if the tariff policy were to get paused, the market probably rips higher considerably.
Right.
So that speaks to the fundamentals thing that you'll see a lot of professionals talking about.
Yep.
Which I think there's a lot of investment advisors who think that's one of the best soothing discussions. And I think it's one of the most horrible, because if you go to a layperson and say, don't worry, the fundamentals are great, they don't know what that means.
Right.
And when you say that against the backdrop of CNBC showing them that they've lost another $50,000 in their portfolio, now they're really confused. And the more confused they get, the more freaked out they get.
Yeah.
Because there's an incongruency with don't worry, the fundamentals are fine, and I lost more money. Those two things aren't supposed to work together.
Right.
So that creates more confusion for a number of people. And the less they see at least some part of their portfolio declining, the less worried they need to be. If we can go to somebody and say, listen, the market side, it doesn't look so good right now.
Yep.
And that's unfortunate, but these things happen. But you don't have to worry about that because you have this other position. And if you need to go lean on that position for the next year or two in order to get this position, this stock part that's more volatile to come back and prosper, that's fine. That's what we did this for.
Right.
That creates a lot more peace of mind. And it's a lot better than, the stock part's not doing so well. And look, bonds, for whatever reason, interest rates keep going up. So the bond fund that you bought, that's getting hammered too, huh? Don't know. Something weird is up.
Yep. I agree.
And of course, there's always the opportunity with life insurance to say, well, if things are going down in value, but we think they're probably going to go up at some point in the not too terribly distant future, maybe we take some of the cash in the life insurance policy and buy these other things for a short term to see what we can get out of it. Hard to time, but when we get movements as big and broad as this, you can be only half right and still make money.
Right.
And
we're not advocating that anyone do that.
We're not making any specific recommendation to anybody.
Because we don't know anything about you people who are listening. So
correct. And the other thing about that is if you make that kind of move, as opposed to, hey, I'm going to sell a position that I have in a bond fund, for example, which has gone down, but not as much. Well, now you got to deal with the possibility that you might have had a gain in that, and there's taxes that you might have to pay on that in order to make that. None of that exists with life insurance.
I actually view that as one of those situations where I take it myself outside of the equity markets, so to speak, but I view it through the lens of, if my neighbor's house is worth $500,000, but for some reason they were selling it for $250,000.
Yep.
I look at that and go, I take some money out of my life insurance policy and buy that thing because even if I'm half wrong, I'm still okay.
Right. There's enough margin, so even if it sells it at $325, I'll do okay.
Yeah. I could sell it at $500 if I did a full remodel, or I could sell it for $400 if I don't touch it. Yeah. Okay. Either way, I'm good. So
right.
to me, that's one of those. I always say, for accessing cash value to quote unquote invest. I don't necessarily mean in the market, but just in general. If someone just lobs you a fat pitch over the middle of the plate, that's one of the reasons, not the main reason you have the policy, but it is a source of capital that you have to use for those purposes.
Yep. Okay. I think that that's a good amount of rally cry for today.
Yeah. Horse beaten sufficiently.
We'll leave it there.
All right.
I am Brandon Roberts.
And I'm Brantley Whitley.
Thank you so much for joining us. We will see you next week.